My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job's not just to entertain, but put days like today into context, because they're crazy. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Maybe it is just time for others to shine. That's how I feel about the new break in tech's momentum. The break that started with Salesforce 2 days ago, and then accelerated yesterday with disappointing reports from several software companies. And Dell, the gigantic hardware supplier and integrator. Yep, the tech-laden NASDAQ spent most of the day getting slammed before finishing down just 0.01% thanks to a crazy town late afternoon run that we're all trying to get our heads around. But the Dow soared 574 points. The S&P gained 0.8%. Not bad, huh? Both, again, aided by some wacky end-of-the-month buy program that was invisible to all but those who jammed it through. The jarring nature of the tech sell-off took people by surprise, sent them scurrying far afield, including the stocks of companies that seemed to have done nothing. And then at the end of the day, with the buy program, finished up huge, startlingly up surprising levels. Didn't seem right to me, but that's what happens. I think there will be soon seller's remorse for tech. Yeah, a lot of the tech selling seems overdone. Now, take a look at Salesforce. That lost more than 50 points yesterday. It was able to bounce 16 points today. Dell, which had run up tremendously for weeks now, got blasted for delivering an inline quarter. Well, guess what? It wouldn't surprise me if it can't recover, and maybe recover fast. But hardware companies like Dell, which are connected directly to NVIDIA and its AI efforts, may have more room to run versus the enterprise software plays that have had gigantic multi-year moves, often with little connection to AI. We don't think less of artificial intelligence regime if MongoDB, which is a database company, reports slowing and sees its stock plunge nearly 24% in a day. No! By the way, I like engineering software. I like engineering, period, more than I like enterprise software, which is just a wasteland right now. With that in mind, though, let's see what's on tap. Ha ha ha! Maybe it's a bid from Suntory for Samuel Adams. What's on tap? No, we're going to our game plan right now. Our game plan could reveal the direction of enterprise software as soon as Monday, when GitLab reports after the close. GitLab's a key player in another form of enterprise software, the incredibly hot DevSecOps, or development, security, and operations software space. Key teams that help build software applications. Now, there are literally dozens of these companies, and they've been rallying like crazy ever since the Fed stopped tightening last fall. GitLab reported a disappointing quarter last time, and it seemed, well, kind of one-off. Now I wonder if it wasn't a precursor to what we've seen in software this week, where company after company keeps saying customers are skittish and sealed deals are awfully hard to come by. Measured. We'll soon find out. Now, I have been a gigantic believer in the rebuilding of corporate America, especially in the construction of data centers, which is a big reason why I happen to like the stock of Ferguson. That's a company that supplies plumbing and heating, ventilation, and air conditioning equipment. We had them on not that long ago. I think it was a terrific way to invest in the infrastructure build-out. After the close, boy, talk about terrific investment. We got CrowdStrike. Now, this is the lone cybersecurity company that hasn't missed its quarterly projections, aside from Zscaler, which we're going to hear from later. CrowdStrike CEO George Kurtz is money. I bet you he does a great job. Hewlett-Packard Enterprises reports, too. We want to hear if this competitor to Dell, which, remember, was down really big today, is seeing any slowing or price cutting. You know, the weakness in all things data center today was painful, directly stemmed from Dell. Maybe HPE can instill some confidence again, and that's where that seller's remorse will come from. You'll want to be buying the tech stocks again in the data center if these guys have a good number. And then we had PVH, the apparel company behind Calvin Klein and Tommy Hilfiger. Saw its stock poleaxe last earnings season. When it comes to apparel, you know I like Ralph Lauren. Much more consistent time on our brand, especially ahead of the Olympics. Next, everyone's always talking about the changing habits of the working class consumer. We know that times have gotten tougher with higher interest rates and inflation still running. Well, you'd think the Dollar Tree would be crushing this environment, wouldn't you? But it hasn't been. Instead, it's a victim of higher prices and suboptimal management. I keep thinking Dollar Tree will turn, but somehow the value proposition seems to be waning. When I go to my Dollar Tree candy aisle this weekend, I'm going to give you a full report on Monday about what it was like. Now, Campbell's Soup Yes, CPB has been holding up rather of late, and I wonder whether it's seeing some deflationary inputs that could give him an upside surprise. I think CEO Mark Klaus has made the best of what just kind of an okay situation. I believe in him. I believe in the company. I think it's on solid footing. All right, what killed whiskey and bourbon? Was it the cannabis? Was it the GLP weight loss drugs? Was it those doctors who keep telling you can't be a heavy drinker anymore? All right, whatever it is, let's hope this time around Brown-Forman, the maker of Jack Daniels, and all those other ones like the Tennessee Honey, Jack Daniels, all that stuff. And what is with the Fireball? That's not them, but what is with the Fireball? I mean, enough of the Fireball. I mean, it's like Captain Crunch. All right, anyway, I can't recommend the stocks we figure out what the heck is going on with liquor that people have stopped drinking the browns and the clears, which is vodka and gin and whiskey and bourbon. Oh, and then again, of course, we want to find out whether Centauri has decided that it's time for Brown-Forman to finally stop going down. Speaking of stocks that won't stop going down, how about Lululemon? Yes, Lululemon reports after the close, and this stock, which had once been a superstar for ages, now feels like it's wearing cement galoshes while swimming in the East River. Now, we know there's some turmoil in other companies that have crowded into the athleisure space, but what matters is whether all the bad news we keep hearing is already baked into Lulu stock. Hey, don't forget, by the way, that Friday's thing where you don't work, that's over. People coming to work, they don't come to work at Lulu. All right? They don't. And if you do, you ought to rethink your apparel. When we've seen these stocks and they seem to not know how to bottom, they often make a stand when they report. But trying to bet on that is a harrowing experience. I'm not going to recommend it unless you got nerves of steel, tungsten. While we're on the subject of stocks that don't seem to know how to borrow, I am shocked. I am shocked at J.M. Smucker. It can't seem to find its footing. I think that the near 4% dividend yield might create a bit of a floor, but Smucker needs to find something to make them grow faster. I wish they ought to merge with someone. I'll get back to them. I'm beginning to get a little nervous about next week because now we're starting to see companies I've just mentioned, not so good. DocuSign. DocuSign reports, I keep thinking they're going to show us something that's going to reignite that growth. Rekindle our love affair with the company that made it so much easier to close business deals or real estate transactions. I'm just glad it's not up to me to figure out how to turn this thing around. Sometimes I just wish DocuSign would merge with the other big COVID play, that struggling post-pandemic Zoom. ZoomDoc, DocuZoom. You get me, right? Makes sense. Finally, on Friday, we have the most important story of next week, at least when it comes to the economy, and that's the Labor Department's non-farm payroll report. How funny is this? Help wanted. No, I want to be really clear on this. The Fed will feel no pressure to cut rates until unemployment breaches the 4% level. The Fed needs to see people lose their jobs while wages stabilize. Until that happens, they can't take action. We can talk about them taking action, but they won't. It's just that simple. I have no idea how we've all gotten so fixated on the outputs of the labor market. We're always going to have all sorts of inflation for all sorts of things as long as the economy's at full tilt. I don't want to root for job losses, but historically, throwing people out of work is really the only tool the Fed has to fight inflation. When people get fired and businesses close, when the apartments, the rents, the homes get too expensive, and the people in their 20s and 30s get laid off, you know what they do? They move back with mom and dad. They can no longer afford to live where they're living. They may not be able to pay for their cars anymore. They don't take out insurance anymore. They become what I'm calling walking deflationistas. I coined that just now. But that won't happen until unemployment spikes. I have no idea how we got to all the CPI price deflator roller coaster. What is that about? Enough, Magic Mountain. These changes are determined by Friday's numbers. So the bottom line, to those of you who want the Fed to cut so badly that you're staying on the sidelines until they do, you better hope we get some weakness in the employment numbers next Friday. Otherwise, I'll tell you what, see you in July, Chief. Let's go to Kathy in Connecticut. Kathy.
Thank you, Professor Cramer, for taking my call.
Aye. What's up?
I need some help with Pfizer. I don't know what to do. Sell it? Hold it?
No, look, at this point, look, I think that we're going to see some results from CJ. Remember, they bought Seattle Genetics. Pfizer's got that yield. They're paying a weight. It's kind of like a CD with maybe some upside. Okay, how about Mike in the Illini? Mike.
Jim, how are you?
I'm good, Mike. How about you?
I'm doing okay. I talked to you 2 weeks ago. You told me to buy more of this enterprise software stock, and then the last 2 days, they've all been getting crushed. And I'm wondering what you want me now to do with ServiceNow.
All right, ServiceNow, I think that may be the exception. ServiceNow could be an exception. We don't know. I mean, they've got that rule, they got the rule of whatever, and they're doing terrifically. They're like up to Rule 90. Rule 9. They have not missed. They have made, and by the way, I made a comment the other day about Jensen and wanting to get with Jensen. They may be the only guy, I swear, they may be the only one that if you go to NVIDIA, you might see a ServiceNow button. I kid you not. There. Now, if that's straightened out, look, if you're sitting on the sidelines waiting the Fed to cut rates, then you better hope we get some weakness in next Friday's jobs report, okay? Otherwise, I'll see you in July. On Mad Money tonight, Zscaler reported an earnings beat last night and jumped higher in today's tape. I'm seeing if the stock can keep moving towards the clouds with its AI developments and recent acquisitions when I discuss the CEO. Then, can Gap's new leadership keep delivering? I'm diving into the comeback story after the retailer's incredibly great report. And the Investment Club, we hosted a monthly meeting yesterday, and we still had so many questions that we wanted to get answered that we're going to give you a taste of the club right here on Mad Money. So I suggest you stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Okay, this is one of the worst weeks for enterprise software stocks in recent memory. Today, we got a major exception. I'm talking about Zscaler. That's the cloud-focused cybersecurity company that reported a fantastic quarter last night. Management issuing better than expected guidance for the current quarter, while also raising their full-year forecast across the board. And that's why this stock could jump 8.5% today, although it's still down over 23% year-to-date. So what exactly allows Zscaler to buck the downward trend here? Let's check in with Jay Chaudhry. He's the founder and chairman and CEO of Zscaler to get a better read of the situation. Mr. Chaudhry, welcome back to Mad Money.
Jim, thank you. I'm delighted to join you again.
Well, I'm thrilled to see you, sir. Your CFO had something really interesting to say. At one point in the call, he said, our results exceeded our guidance on growth and profitability, even with ongoing customer scrutiny of large deals. Now, Jay, everyone tells me as soon as you have ongoing scrutiny of large deals, therefore you miss your quarter. Why could you make your quarter despite ongoing scrutiny?
Yeah, there is real scrutiny out there, but scrutiny is to make sure customers can save money when they deploy new solutions. Most of the software companies, they have enterprises spend money for a year or two. Then they start saving money. With Zscaler, we end up replacing a number of point products. It could be firewalls, VPN, VDI, lots of products. And when those products are taken out, customers can get better security, better user experience, and save money. That's why we are able to deliver great results. We beat our targets across all metrics. We're very, very excited and proud of it.
I am so glad you mentioned that, because one of the things that I saw last night was that you were talking about taking out $1 million worth of other technology, do it much more Q1, Q2, Q3. No one else in your business ever comes on and says, you know what? We actually make a good deal for our customers. It's always like, hey, they can't afford not to take us whatever price it is. So what makes your software so exceptional that people actually think it's a bargain?
So, Jim, it depends on the technology. Think about a television you bought 7 years ago for $3,000. Today, the newer technology, you can buy a better television for $1,000. Most of the security products in the market today are built on traditional firewalls, VPN technology, and they keep on bolting more and more stuff on it. It's expensive, it's complex. I like to say Zscaler is like an electric car compared to a traditional car. When you come with a new architecture, it's cheaper, it's faster, and better. That's why we're able to remove a lot of point products. Your point is right. Look at most of the security companies. You have to spend money. Security is not about saving. Even SaaS company, you spend money. We are able to take out the cost of networking, security appliances, and make it easy to operate. But we have to create business justification to show the CFO and CIO how we do it. And that's why we are able to close deals, because we deliver value to the customer, even though our price is not the cheapest.
So you do show them, for instance, that your platform prevented over 2 billion phishing attempts. That was up 60% year over year. Incredible how dangerous this game is, huh?
It's getting more and more dangerous. In fact, Gen AI is making it easier to do more sophisticated phishing attacks, because those attacks Gen AI generates look like real, an email coming from your CFO. So now our technology can actually scan and look for that kind of stuff and really figure out what kind of attacks are being generated by Gen AI or some other sources. It's a race with bad guys. We're fighting AI with AI to protect our customers. So customers see value, not just around traditional security, but taking them to zero trust architecture and to protect them against the AI-powered attacks.
So that's why I need the AI-powered Copilot ZDX?
Yes. So ZDX is about digital experience. It's more than just cyber. When you are accessing applications, sitting in some island or some hotels and things are slow, often executives don't know what's going on. They get frustrated. Our ZDX Copilot will tell you exactly where the problem is. It may be your Wi-Fi. It may be the last mile. It may be the laptop. We make it easy for customers to figure it out and take care of any performance resolution.
Now, one of the things I thought was amazing, when you go over some of the clients, there are large banks that don't have your kind of zero trust. They're just out there and they just don't have anything.
Jim, lots of people think that just because they got firewall and VPN in the cloud, they got zero trust architecture. There's a lot of misinformation out there. Zero trust architecture is the opposite of traditional firewall-based security. We don't put people on the network. That's fundamental. The reason we are winning some of the largest customers is because we pioneered zero trust architecture. I don't have any legacy security appliances or firewall as my business. Traditional security companies have to worry about cannibalization. They want to protect those appliances. I don't. We go and eliminate those appliances, save money, and do better security.
Boy,
that's what's driving our growth, even in the soft market.
That is so clear. It's such a clear value proposition. But let me give you one that really confounded me. You said, after experiencing a catastrophic cyber attack last year, a large financial services new logo customer purchased your ZIA data protection. Did other banks see that and not take you up on this?
So they do. That's why 8 of the 10 largest banks in the world outside China are Zscaler customers. Similar number of insurance companies. That's why over 40% of Fortune 500 companies depend upon us. That's what's driving our growth. The only thing that's holding us back is inertia. Sometimes it takes a lot of time to educate people that traditional legacy is not good. You need to move to the next step. And that's part of the job my sales team is doing.
Well, the thing I was most happy about when I read your quarter, frankly, was that the Department of Defense, which I would think we cannot afford them to be broken into, that you got that contract. That's got to be the most important contract in America.
It's exciting. And to me, Zscaler is not just a business, it's a mission. And to work with DoD to secure them is nothing but being very proud of.
And are there people, bad guys every day, trying to get into the Department of Defense?
Everywhere. DoD is a big target. Every big federal agency is a big target. And it's our mission. We got a sizable research security team. We're getting 400 billion transactions a day. That's telling us what kind of communication is happening out there. Before any breaches happen, reconnaissance goes on. We're able to see a lot of that reconnaissance, put them together, and try to identify where the bad guys are coming from, where they could be headed. So this network effect makes Zscaler cyber protection better than most of the other companies out there.
Well, you're right. It is a mission, and that's probably one of the reasons why you were able to buck the trend. Obviously, what you're doing is very revolutionary versus what everyone else is doing. Jay Chaudhry, founder, chairman, and CEO of Zscaler, ZS. Thank you, Jay. Good to see you again.
Jim, appreciate it.
Absolutely.
It's always fun to be on your channel.
Oh, you're very kind. This was the one that survived the gauntlet, people. Mad Money's back after the break.
Coming up,
This is no off-the-rack analysis. Cramer tailors a bespoke breakdown of the Gap's quarter next.
This phase of earnings season has been absolutely nuts, with stock after stock making major moves both the upside and the downside. It is crazy out there. It's not unusual to see a household name moving double digits in any given session, either because of all the surprise shortfall we got like Salesforce on Wednesday night, or a stunning upside surprise like the one that just sent the Gap up almost 29% today. That's even more impressive than the monster run in Abercrombie & Fitch earlier this week. In fact, the Gap has now roughly tripled since CEO Richard Dixon took the reins in late August of last year, almost immediately pushing through one of the greatest turnaround stories I have ever seen. The company already looked to be improving when we heard from them last November, but after Dixon's first full quarter on the job, it reported a set of truly stellar numbers in March. A lot of people were baffled if it can't be happening this fast, and they sold it back down. Now, we had him on the show that night. I came away extremely impressed. I mean, this guy knows stuff. Dixon told us all about everything he was doing to breathe new life into the business, including his plans to reinvigorate the core Gap and Old Navy brands, which people pretty much given up after a lackluster performance. He also mentioned making a more conscious effort to position the company closer to current fashion trends, while approaching the business with more operational and financial rigor. But Dixon also made it clear that the turn is still in its infancy, a lot more work to do, especially with Banana Republic. Now, Gap was at $19 before that March quarter, and over the next 2 weeks, it quickly ran to $28 and change.
That was easy.
Which point, you had a massive gain. This was a $7 stock just a year ago. However, late March is when the stocks... Remember, the stock market started rolling over, all the momentum plays got hit, and at that point, the Gap had a ton of momentum. Plus, Wall Street started tearing its collective hair out, worrying about the state of the consumer. As of last night, the stock had pulled back to the low 20s, which was pretty amazing. Then Gap reported after the close, and once again, Richard Dixon, well, he knocked it out of the park. Hence today's 29% move. If you didn't know any better, you'd think the guy's got a takeover bid. There's a reason why the stock turned into a rocket ship. Gap reported better than expected net sales. Same-store sales up 3%. Wall Street was only looking up 1.1%. That's a huge upside surprise. All four of their brands this time, Gap, Old Navy, Banana Republic, Athleta, had positive same-store sales. I did not think that could happen. All four were better than expected, especially with Athleta, although Athleta is small, with 5% same-store sales growth. Analysts are expecting 4.7% shrinkage. Now there is a turn. Gap also delivered the operational financial rigor that Dixon promised 3 months ago. The company's gross margin, what they make after the cost of goods sold, expanded by 410 basis points year over year to 41.2%. Now, the street was only looking for 38.7%. Their operating margin came in at 6.1%. That is more than double the 2.4% number the analysts predicted. The analysts are so far away from what this man is really doing. And that's how Gap ended up posting a 27-cent earnings beat off a 14-cent basis, locking in their fourth straight bottom line beat of epic proportions. Another huge positive. End of period inventory was down 15% year over year. When you keep your inventories lean, you don't have to mark your merchandise down. No promotions. Get out that stuff. You don't need to push it. No wonder the margins were so strong. The Gap's guidance was strong, too. The company raised its full-year forecast for net sales, gross margin, and operating income, even as management says they won't need to increase their operating expenses or capital expenditures outlook. I was just blown away by that. The cash is going to pile up quickly here. Now, for the current quarter, Gap guided for better than expected sales and much better than expected gross margins. On the conference call, Dixon once again struck a balance between touting the Gap's recent accomplishments and still emphasizing that the best is yet to come. He was not overconfident one bit. I loved his tone. Near the top of his remarks, he explained that, and I quote, "We are on a journey to become a high-performing house of iconic American brands that shape culture, but this will take time, perseverance, and rigor. That said, I am encouraged by the momentum and the results." He also had a lot of interesting things to say about reinvigorating the brands. Listen to this one. Old Navy is seeing product improvement across the board. Gap brand is seeing success in standing behind big ideas. Banana Republic is making headway with its classic line, and Athleta product innovation is gaining traction. He goes on to say, quote, our products are being amplified through more compelling storytelling across each brand, cutting through with clarity and better differentiation, end quote. Their ads are stupendous. I don't know if you've seen the most recent. Have you gone to Banana Republic lately? The stores are a knockout. I'm not kidding. A knockout. At Old Navy in particular, which accounts for more than half the company's sales, Dixon said they're working very hard to strike a balance between value and quality. That's good. That's what they have to do. Very important in an environment where most customers are desperate for a good deal. But the biggest surprises from the Gap quarter were the much better than expected results from two brands that he had been very concerned about, which are Banana Republic and Athleta. Again, these are not big brands, but they were still struggling a bit when the company last reported in March. For Banana Republic, Dixon said, and I'm going to quote here, classics and finest fabrics perform well, benefiting from foundational improvements, including increased product depth in stores, elevated marketing, and better site execution, end quote. And that's what I was referring when I went to the one in Short Hills Mall recently. I could not believe it. And this stuff is not expensive versus its peers. He also noted that the company decided to, quote, commence a leadership transition, end quote, for Banana Republic at the end of the first quarter. So while this quarter was nice, I think there's plenty of heavy lifting to come. But, wow, he's got a lot to work with. Now, as for Athleta, there's activewear brand. Now, this 5% same-store sales growth, I found it borderline shocking, frankly. Remember, its analysts expected to be more like down 5% because the athleisure category hasn't been doing that great. Look at Lululemon. But Athleta's apparently killing it with their yoga pants. They are not a competitor of Lululemon. Lululemon is so much bigger. But it was encouraging to see how that finally this moribund brand, he breathed life into it. Now, with the U.S. Gymnastics Championships this weekend and the full Olympics coming in July, it is worth calling out the fact that Athleta counts gymnast Simone Biles and swimmer Katie Ledecky. They're both brand ambassadors. He is so good at picking those people. Hopefully they keep winning. Dixon spoke about how, quote, this year has been a major step forward for women's sports as female athletes globally are beginning to get the attention and credit they long deserve, end quote. Presumably alluding to the success of the NCAA women's basketball tournament, which racked up incredible ratings, by the way. We know activewear is a crowded category, but Dixon seems to have found the right message with Athleta. Now, I could go on and on because I'm just thinking this turnaround is real. Dixon spent some time talking about how what they're doing to improve supply chain management, technology, marketing. In terms of marketing, Gap plans to centralize and optimize. I didn't know they had. Their media mix sounds good to me. Dixon also spent time talking about strengthening the company's culture with town halls to hear from employees and generally build enthusiasm for the organization. Is that ever needed? But here's the bottom line. If you couldn't tell from this stock's monster run today, the Gap comeback is very much on track. Buy. Now, the blowout quarter, the analysts will get wise to what's happening here and raise their estimates more aggressively, eventually making it harder for Gap to surprise to the upside. But, man, even after the stock quadrupled in just over a year, the darn thing only sells for just 16 times next year's earnings estimates. I'm betting those estimates are way too low. Yet, even after today's move, believe it or not, I still think it is not too late to fall into the Gap.
House of pleasure.
Hey, you know what? We should go to Dan in South Carolina, I think. Dan.
Greetings from South Carolina, Jim. I'm a first-time caller, a short-time listener around 1 month, and a proud club member of around a week.
Whoa! All right, then maybe you caught yesterday's presentation. Dan, I am so thrilled to have you on the show. Let's go to work.
All right, I'm trying to free up some cash to invest in some of the stocks recommended by the club, or in the club.
Okay.
And the problem is I own a stock that got heavily hit by COVID that I know you don't really recommend. I got 600 shares at $20 a share, and it's trading around $15, and I'm trying to figure out when to get rid of it. It's Carnival Cruise Line. They report earnings on June 23rd, so I don't know what the right time or the right price. I'm sure.
Let's wait for the quarter. Let's wait for the quarter, and then I think the last couple cruise companies have reported good numbers. But you're right. I would much rather see you in almost any stock we own any stock we have in the club than that one. And you've got the list, so go to work. All right, look, the comeback of Gap is very much on track. And even though it's quadrupled in just over a year, believe it or not, I don't think this story is anywhere close to being over. Much more Mad Money in it. After the break, I'm taking club questions. We just talked about the club with Dan from South Carolina. We're going across the country, give you an inside look at what Jeff Marks and I do every month for our members. Plus, Costco dipped lower after yesterday's positive report. I'm telling you why this might be just still one more chance to buy. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Yesterday, we held our Investing Club monthly meeting. Now, once a month, Jeff Marks and I get together to walk club members through our thought process of how we make decisions for the portfolio. We discuss our current holdings one after another because people want to know each one. And then we take questions from our club members. My favorite part of these meetings is taking your questions. And since we didn't have enough time yesterday to go through them all, I'm going to give you an inside look at what we do for the club, and I'm doing it right now. So I want to start with a first question from William, who asks, when a stock comes in, at what point do you slow your exposure, especially when battling a tough stock? Fundamentals are still solid. However, market sector and volatility are taking its toll. What are the most important factors? Okay, so let's take a look at this one. First of all, let's understand. When he says slow your exposure, what he's really saying is, what point do you stop being really aggressive buying? So if you have a stock that, say, is at 100 and you're afraid with the market volatility it could drop to 80, how do you buy it in steps? Now, I like to use what's known as a pyramid. So I would start right here, say at 90, and I might buy 25. Then at 85, I might buy 50. And then when we get to 80, I might buy 100. Now, the only problem with this, obviously, if it goes to 70, then you're stuck. And that is something I talked about this week. But I will say this, that the volatility, if there's really a lot of volatility, then what you do is you use smaller increments. Maybe you start with 10, and then 15, and then 25. Volatility means smaller increments. Less volatility means bigger increments. And it's all an art, not a science. Next up, we have a question from Randy in Texas. He asks, Uber has underperformed as of late, down 18% in the last 3 months and down almost 3% in the last 30 days. What is your thought on this stock? Buy, hold, sell. I happen to like Uber very, very much. Now, I happen to like Lyft now, too. Maybe there's a little competition, but Uber is so big and so powerful that I'm not that concerned. I would be happy to buy stock in Uber right here, right now. Our next question comes from VJ in North Carolina. VJ says, I recently bought Reddit, RDTT, at 49 and went up to 65 within 2 weeks. I believe in the long-term story, but is it appropriate to book some profits and buy back later if there's a parabolic move like this immediately after you buy? Or should I hold on? Okay, now listen, this is really important. Reddit is what I call an unseasoned stock. It hasn't been public very long. So an unseasoned stock, we don't know how it is going to trade. Each stock has a different feel to it. That's something that I teach in the club. And Reddit had this kind of what was amounted to be like, and ARM Holdings had the same thing, just whoosh right up. When it goes whoosh right up, I actually allow you to take some profits. I happen to like Reddit, so I would normally not take it. But in that particular case, yes, you're free to take some, and then when it comes back in, because all parabolic moves come back in, then you buy it back. That move was a parabolic move. You identified it. I identified for ARM, too. But I will say, ultimately, Reddit is a great stock, and you know I want to buy it for the charitable trust. Now I'm heading to Kathy in Florida, who's asking, Jim said NVIDIA sees the healthcare industry being the largest industry in the future for AI. What companies should I invest in now, be set up? And okay, now just so you know, there's a Recursion. We had them on, but I like very much what Medtronic is doing. I wish GE Healthcare would do something with them, for heaven's sake, or maybe if they're doing something less than token. But the problem with NVIDIA and healthcare is the companies have not come forward yet. They haven't come forward. Big cap biotech, big cap pharma has not yet embraced the things that NVIDIA is doing. And it's their mistake. And if I were them, I would call Jensen and say, how do I get out there and tell me how to make the most use of all the great stuff you have? Because they have not been the adopters I would have expected. Now we have a question from Joey in New York. Joey says, Airbnb has been in the bullpen for a while. What are you looking for before adding to the portfolio? Joey, this is really easy. I'm looking for it to come down. I can't pay up for Airbnb as much as I like it. I just posted, by the way, there's a People magazine piece about one of the great new houses that he has. He has all these I'm talking about Brian Chesky, has all these special venues. And take a look at my Twitter feed right now, and you'll see. And as far as I'm concerned, Brian Chesky has defied all of the naysayers, and you're absolutely right. I'm going to double down and see if the stock doesn't come in and maybe get some on the sheets. We have 33 names right now. I'd like to have more. Club 33 needs Club 35. All right, next up, we have a question from Fred in my home state of New Jersey. What books about investing in general does Jim recommend? Which of his books are relevant to today's market? Okay, first, a lot of people still think that Real Money is my best book. It's my most elemental book. I like Getting Back to Even because there's a lot of good stuff about options in there. But I will tell you this, that if you want to know my all-time favorite business book, it's One Up on Wall Street by Peter Lynch, who is the great manager who made me and my family so much money in Magellan. And then Only the Paranoid Survive, which is a fabulous book about business that taught me a lot about discipline. All right, now let's head across the country to Frank in Washington, the state of Washington. Frank asks Toll Brothers, consistently puts up great quarterly results and has a market niche for continued success. Why doesn't the stock have more love, higher price for investors? Well, this is a very interesting question. I think some of it is because a lot of people feel that Toll is still this little home builder from Philadelphia. It is most certainly not. Other people think that, wait a second, how long can make $1 million homes in this country when only 8% of the people make more than $100,000? It is an interesting question. The answer is that we don't have many $1 million home builders that they're up against. I think that Doug Yearley is doing a remarkable job. I think he's excellent. And the biggest question you should have asked of me is, how the heck do you not own Toll Brothers, Jim, yourself, since you're such a big fan with them and you've actually done some business with them? And the answer is, I have not always addressed myself correctly when it comes to the home builders because I've always been nervous because I fear rate hikes. And you know what? I should be more fearful of rate cuts and missing Toll and missing Lennar, both of which have been amazing stocks. Last, but certainly not least, we know that. We have Sonny in Massachusetts, and Sonny says, quote, with summer vacation coming, should we be buying travel companies or cruise lines? Okay, I used to do that stuff. I used to say, oh, a trade comes, summer vacation. Here's the problem, Sonny. When I used to do that, I was one of about like 40 people that did that. Now you're dealing with 4 million people looking at that trade. We don't want to trade. We want to invest. So we're not going to be trading off the summer or the winter or anything else. What we're going to do is find solid companies and invest in them. And in the cruise lines, the one that I like best is Royal. And then secondly, I like a Norwegian cruise line. And I'm doing a lot of work on Viking, which, by the way, turned out to be a pretty darn good deal. Mad Money is back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. Same the stock is started by social some don't know the call. Shock question at the time. I step for playing this out. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. I'm going to start with Andrew in South Carolina. Andrew!
Booyah, Professor Cramer.
Liking that. What's happening?
Not much, man. Seeing if you think I should bulk up on this stock or if I'll lose weight. EKTX.
Viking Therapeutics. I'll tell you, I even like the Vikings more than I like Viking Therapeutics, and that's saying something because they ain't that good. I say you need to be an Eli Lilly. Step your game up, partner. Let's go to Paul in Michigan. Paul.
What's going on, Jim? Booyah.
Booyah to you. What's happening?
Oh, not much, man. Just trying to make it. I got one for you. HB Fuller, FUL.
One of the first stocks I've ever bought. It's chemical company. It's got a lot cooking, and I say, but be careful because it's really boring. Let's go to Tom in California. Tom.
Hey, Jim. Thanks for taking my call. How are you today?
I'm actually pretty good. How about you?
Good.
Excellent.
Hey, I have a position that I'd like to pass by you. It's AstraZeneca. I don't know whether it's...
is this Tom in California? You got horse sense, partner. They have two presentations, not one, but two presentations this week at ASCO in Chicago. Why do they hold it in Chicago? I don't know. I have to ask ChatGPT. But this is an amazing team that they've got at AstraZeneca now, and they've got fantastic formulations in oncology, but also heart, and they have a GLP-1 kind of thing going on, but it's a little further removed. I think that their stuff for breast cancer is amazing, and for lung cancer is incredible. You've got a winner with AstraZeneca. I need to go to Joe in Texas. Joe.
Booyah, Jim, from the Lone Star State.
Well, I like that immediately.
What are your thoughts on Hawaiian Electric Industries, ticker HE? Hold or get rid of it?
Have you ever heard of AstraZeneca, which is a... Never mind. No, you don't want to be Hawaiian Electric. Come on, you don't want to be Hawaiian Electric. That's no. I want you to be in Pacific Gas and Electric. No, I want you to be in Exelon. I want you to be. I don't care what utility you're in, other than that one. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Coming up, say nay to the naysayers of Costco. Stay tuned for Cramer's wholesale endorsement of a stock the market loves to hate. Next.
Some stocks just can't go up after earnings, no matter what. Yet as soon as the inevitable decline occurs, we run around like chickens with our heads cut off trying to find out what went wrong and why the stock goes down. When the darn thing gets hit nearly every time it reports, well, what's there to figure out? When it happens with Costco, and it seems to happen almost every quarter, searching for a reason is a total waste of time. Yet people can't resist. They just keep looking for explanations. They can't even come up with plausible ones, even if they invariably turn out to be untrue. Costco got hit once again today, after reporting great numbers, much to my chagrin, but there was nothing I could do about it. Now, though, I get a chance to tell you why the stock of this tremendous retailer is such an amazing buy after it settles down. That could take several days until people accept that nothing's going wrong. But eventually, these pullbacks turn out to be fantastic buying opportunities. Why am I so certain? First, even though Costco has both a new CEO, Ron Vacaris, and a new CFO, Gary Millerchip, I'm not concerned about the transition. Ron's worked at Costco for 4 decades. He started as a forklift operator. He knows his way around. As president and chief operating officer from 2022, he worked closely with CEO Craig Jelinek. As for Gary, he's the former CFO of Kroger, where he worked for 15 years, and he's an incredibly solid executive. He does have gigantic shoes to fill, though, because he follows Rich Galanti, who served as Costco's CFO for 40 years. He was known to be the primary voice of Costco and one of the best in the business. I can attest he's also the funniest, but nobody can work forever. I think Millerchip's a good successor, but a Galanti conference call was always an amazing production. Without him, the call was dry, but the substance was anything but. All explained with the help of a deck. They usually don't do that. Extraordinarily helpful, frankly. Second, Costco's continuing its tradition of doing everything it can to keep prices down. Despite Wall Street's insistence that the company raise its membership fee, this team doesn't want to do anything to make shopping even more expensive than it is. Not with this much inflation in the system. They're as insistent as ever in trying to keep the big consumer packaged goods companies from raising price. And where they can't, they have no problem coming with their own Kirkland signature brand, which, by the way, I find is usually superior to the so-called name brand. They try to provide at least 20% value versus the national brand. Costco single-handedly lowered the price of farm shrimp and pine nuts with some Kirkland signature items. They even created their own walking shoes and makeup removers. And as Millerchip said on the top of the call, quote, while I can't promise to be able to match the humor Richard Galanti has become famous for, I can promise the same level of open dialogue and transparency you've come to expect. Oh, and to clear up some recent media speculation, I also wanted to confirm the $1.50 hot dog price is safe, end quote. Now, that's a guy who's got priorities right. Of course, Costco's actual numbers were superb. The company earned $3.78 per share. The Street was only looking for $3.70. Revenues came in at $58.52 billion. Analysts were only looking for $58 billion. Same-store sales grew by 6.6% versus the 6.0% we were looking for. Right down the middle of the fairway. Plus, after a prolonged drought, they're gaining in discretionary items like toys, tires, lawns, gardens, health and beauty aids. And they are just crushing it in bakery sales. All in all, the Costco quarter was perfectly better than expected. And the only thing that was imperfect was the stock's inevitable decline from its all-time high levels right before it reported. That, of course, isn't new either. This is what always happens with the stock at Costco. So let it come in a little, but as I tell Investing Club members, remember to buy some if you don't own it already. And if Costco keeps falling, just keep buying more, because there's nothing else like this company. Never will be. I'd like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.